Good morning, this is Ken Long from Tortoise Capital with the review of the weekend trading reports for May 29th, 2016, Memorial Day edition. Market is in bullish normal conditions. On an annual basis, using the weekly RSI 14, we're at 61 out of 100. With the 10-day NDX, we're at fully overbought at 100 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is green bullish, 5.24% above the 200-day moving average. The slope of the 50 has improved to white bullish, 0.33. ADX just nudged above the critical point of 15 into neutral trendingness. When it goes below 15, then comes back above 15, we look for whether bulls or bears are in charge, and make the tentative conclusion that the one that's in better shape in ADX is the next most likely trend. Relative volatility 0.97. The risk index is the 30-period moving average of the VIX divided by the 10-period. Less than 1.0 is risk off conditions, but we are at 0.992, so we're just barely into risk off. We take that score and look at the last 5,000 trading days and find the average and standard deviation. That allows us to compute the risk Z, which is at minus 0.17, so we're just into risk off conditions. This is a 90-day histogram of that indicator. We just put in a double bottom here at a relatively minor negative risk Z, and it's been improving this past week in terms of lack of volatility. The last time that happened, we saw this kind of move, which was an excellent swing on the upside. When it rolls over at a position more than 1 SD away from the average and the zero line, then that's when we tighten up our stops and become a little less risk tolerant. These are the holdings for blended monthly rebalancing this month, and we will reevaluate the portfolios on 1 June. So these are the holdings that we will engage in those portfolios, and these are the key leaders based on Friday's price action. In ETF2, the theoretical model is at 100%, the model portfolio is at 100% exposed. This is the blended monthly rebalancing portfolio. As you can see, everything in the 13 and everything except gold and treasuries are above their 4-month moving average. So we're all on buys. This was a rebound week across the board. Last week was down. 2 weeks ago it was down, I should say. This past week was generally up. Leadership in MDY, IWM, so maybe rotation back to the U.S. Small caps have been lagging for such a long time, but maybe that's a hint of some good things to come. In the ETF 32 portfolio, Brazil, commodities, energy, more materials, Australia near the top. In ETF Max, we use that same lens in order to look at the top 50 symbols in the 1,000 ETF database. You can see there was a big give back in gold and silver and other metals this week. Still, their 3-month and 6-month performance has been so enormous that's why they're at the top as we rank by blended performance. But this clearly is a profit taking. It remains to be seen if we have a swing to the other side possible, or if this is a opportunity to buy on dips. If it resumes, there will have been a tradable retracement in here, so we'll keep our eyes open for that. Meanwhile, big winners, high yields, German Bund and sugar, more sugar, some recent reasonable moves here in Russian small caps, oil and gas, market vectors, more natural gas. In the S&P 500, same lens. We're looking at some massive moves this week in Consol Energy, Chesapeake Energy, Hewlett Packard, Applied Materials, Jacobs Engineering, Dollar General, that growth stock for you there, Diamond Offshore Drilling, Navient, Archer Daniels Midland, Equinox, big give backs here in Newmont Mining, Marathon Oil, Freeport Moran. So plenty of momentum choices to be looking at in this week going forward. The market health check. We have vertical blue lines are 10, 20, and 30 days worth of look back. You can see we're only a fraction of a percent off the swing high, almost 15% off the swing low. The Dragon made a high, a swing low, and is starting to creep back higher as we're testing the hump of the Dragon on this last run. And then this is the all-time high, this swing high up here around 212 in the S&P. So this failure to fail further here has resulted like in a double bottom with support at 204. Tested the floodplain, held, and now it's resumed. You can see that the slope of the 10-period regression channel is up. The 30, which is still negative, however, is starting to improve and beginning to oscillate back north. So this has been a 50-day channeling activity. I want you to notice that the slope of the 30 went all the way from a very favorable 0.7, which was much higher than the limit of normal up is 0.4. This got to 0.7 here. And then for 50 days, this sideways churning resulted in the slope of that 30 decaying. Right around in here, it got to 0.4. And then crossed the zero line here at the dotted line. That's the zero line. And still decayed a little further, but has now made the turn and starting to follow the 10 and the Dragon upwards. So that could be a favorable moment indeed. We shall see. Right now, this support level at 204 is really strong. I mean, it's the edge of the floodplain. So 95% of the price action of the last 30 days has been above that line. You can see only this little dip here. So that makes this a really strong support level. And the double bottom makes it a support level, as does this support level over here. Remains to be seen if we can get through 212. Again, I take the position that we're in a election year that's very polarizing, with the difference between the candidates so enormous that the amount of uncertainty baked into the cake, I believe, has to favor a sideways choppy market still. So I would I won't be surprised if it goes through 212, but if it goes through and stays through and makes another leg up, then I would be surprised to see that. I'm not expecting that. I'll be prepared for it, but I think the much more likely scenario is this kind of choppy action that we've seen between about 211 and 200. You know, we've been there for 60 trading days. That's almost 12 weeks. And I see that going all the way through November. Jaws of PPO have opened to the upside. We've been overbought here for a short while. I do take it as positive that it closed with momentum on Friday over a long weekend in which the U.S. remains vulnerable to terrorist activity. Knock on wood. ETF2 regional report. Everything's on a buy signal, so we remain 100% invested. The S&P at 38 is better than the globals at 36. Inside the U.S., it's mid caps, small caps, large caps, tech. strongest sectors, um, Latin America and U.S. mid caps. Two weakest sectors, European 350 and U.S. tech. Some strength in here in the energy sector and the materials sector, although we've seen them start to give that back. Utilities remains a strong defensive play. I just have to think that this healthcare weakness, which had been so strong the previous 2 years, has to reflect the real possibility of Clinton becoming president. World market model. The large caps in the U.S. are below average, as are a couple of the small caps, and then mid caps above average. Japan weak, Asia less Japan above average, with real strength in India, Philippines, Australia. China has moved all the way from the green down to the red. Brazil and Latin America remain strong. Mexico very weak. Everything Europe weak, with the slight exception of Belgium. ETF top 30, using that ETF2 lens, green and white is an indication of increasing strength. So we'd be looking for, this might be an early moves yet in natural gas, the MLPs, the First Energy Alpha Dex. Longer term strength here in gold miners, metals and mining, oil production, but we've seen that's had such an extraordinary run that it took a sharp hit this week, but still remains strong. Latin America and natural resources starting to give it up a little bit here with white and green. That's a reverse of the of strength. That strength coming out of the market. In the Dow, Chevron, IBM, and United Health at the top, with new strength in Pfizer. So that's sort of bucking the trend of the healthcare. So maybe Pfizer looks like and United Health there. Maybe that looks like the strength in the healthcare sector. Also some strength with white and yellow. Here with J.P. Morgan, American Express. These are two financials that have come all the way off the bottom. Down at the bottom, the techs with Microsoft and Apple, Intel near the bottom, but Nike and Disney also at the bottom. As a bottom feeder, I'm always interested in those. Volatility stats, just for liquidity of the intraday trade. Shifting to the daily. A handful of auto framers, 5 days down, and channeling and overreaction to choose from. You can see that the bulls have reasserted here. That strength in the bullish move is what's turning the crank here on ADX to come back above 15. Volatility remains extremely low. Lots of dojis from Friday. Handful of auto framers. ETF 30, again, a few dojis, more on the auto framer 2 to 1 to look at. Lots of good frog numbers. Key price levels in the auto framer, and then key targets for the regression line fractal framework. These in the green on the top shelf are the ones that are the most ATRs below their own RL270. And so this is an example of that that kind of setup. This is Nike. That was the number one symbol. The most ATRs below its RL270. You see this purple line here is the RL270. We treat that as a long-term fair value. For a while, Nike was trading above that price level up here around 67.5. Couldn't hold that. This loss, these losses here have caused the RL270 to roll over. I interpret that as an estimate of what the long-term holders, the position holders, think about as the real fair value of that. So we use the 10-period regression line, which is the blue line, and we compare that to, let me move this out of the way, we compare that to the RL270, that's a distance of 56 to 63, so that's $7. And then based on the ATRs, that's almost 6 ATR away. So what we could say on this one is if it moves 1 ATR off the bottom, then that might be a signal to go long with the target here. You know, maybe initial target, the Bollinger Band mean, far side of the river, Z2, the far side of the floodplain, Z3, which is pretty close to RL270. That would be our target with a 1 ATR initial stop. That would give us something like a 5-to-1 reward to risk ratio. With the downward slope of the river, however, as soon as I got an R in hand, I would be really looking at preserving profits. And to the point where, like right now, we just closed the swing trade on this one. We had this trade here essentially was that same regression line fractal framework, because you see the RL10 was down here, and the distance all the way up to the RL270 was enormous. It moved a certain distance here when it got essentially into the pocket of the dragon. Let me zoom in here for you. This wasn't planning on doing a swing trading lesson, but here we are. So and this moved down here to Z3, and then it got rejected, and then the RL10 rolls up, and now they see the dragon rolling up and the 30 rolling up. This is what we call the pocket entry. So an entry here with a target of the RL270, you can see that it made that, and then when it rejected that, we get the exit right here for that swing. So that's really the hypothesis of the regression line fractal framework, in that we're looking at the difference between the current price as marked off by the RL10 and the long-term fair value marked off by RL270, expressed in units of ATR and minimum 2-to-1 that allows us to take the trades. The next swing trade on this one was when that RL10 rolled over, penetrated through the dragon, and now the 30 and the dragon have rolled over. We're short in here and covered down here, and now the rebound couldn't even get to the Bollinger Band mean and started to fail again. So when the RL10 comes through the dragon, we're short. And then this failure to fail further the last 5 or 6 days after testing Z3 felt like, you know what, that's enough. We'll cash that. And now we're framing this as a, let me get this out of the way. We're framing this as a potential swing to the upside, 5 or 6-to-1. By the same token, if we get price violates 55.50, I can get short on that one again with little to no compunction. So I would set this trade up like this, like about from 57 long with $1.50. It's a little over an ATR. That would be my trade going forward. So that's how we use that regression line fractal framework for swing trading. That's one of the techniques we'll teach at the advanced swing trade course, and which is available on our own home study course as well. Well, now just to complete the record here, we'll take a look at Pfizer. We already saw that was one of the big winners in the ETF2 lens when we looked at the Dow. So that one's almost 8.5 ATRs above its own RL270. So we'll take a look at Pfizer and see what strength looks like in that framework. So this one's pretty easy to see. You see that RL270 had rolled over and started to come up here. This was a pocket swing trade entry, which we got here. Missed this move. That happens. And now Pfizer pushing Z3. And you can, let's take a look back here. That's what a really strong move out of this pocket looks like, is all the way up here, but testing the top of this dragon over here. This is actually a very interesting moment now in Pfizer. Can it hold these gains? You can see from this red line over here that would be a resistance line keyed into the hump of this dragon. That's where it couldn't hold before, and and then this long slide occurred. So now we've got a nice rebound up to this known resistance level. So now this looks to me to be very interesting. We're out here at Z3, if it gets more momentum, I'd be willing to buy that above 35 with a stop down here by the blue line, or by the red line. That'd be about 2 ATRs right there. And then if it fails that, I'd be willing to go short with a target looking at probably return to the Bollinger Band mean around 33, or at least come down and test the support level at 32.5. So this is what that overstrength looks like, and then we saw in the previous one in Nike. That's what the understrength, the weakness between price and the RL270. So we're using that as a gauge of the relationship between short-term and long-term. So if we ever saw a case like way back in here in Nike where the RL10 has met the 270, we would say in that moment all of the market participants are in agreement about what the fair value is. And then we see the short-term traders were able to push it down this far, and then when they took their profits, and the value players, in this case this is value players from the RL270, come and say, man, look at that move, and then they push it back up. Then the traders take over and push it another distance. That's how far the traders can push Nike around, that distance there. That's how far they pushed it this time, how far they pushed it this time, and really this time here. So I take that as a rule of thumb about the power that's resident in the traders to move price around, and then at some point when they move it around enough like that, the longer term players take notice, maybe adjust what they consider to be their fair value. Again, that's some lesson material from the advanced swing course. There's still time to register for the one in Raleigh this summer, and we teach this also in the online self-paced home study course of over 50 hours of video material and lessons, and lots of portfolio management case studies. So back to our reports. These are the daily squeezes, and these are all based on Friday's price action being less than 0.7 of the average range, so very tight compression, but then having large potential intraday moves as measured by the range stat. And so when you take the range stat and divide it by the daily range from Friday, when that's greater than 2, you have the potential for an expansion one-day move, and this is the ratio of that potential. So you see General Dynamics, Amazon, Walmart. So this is what Amazon looks like as that squeeze. It's really in a nice position here. We have an upward flowing river. RL270 is up, the 90 is up, the 30 is outside the river, and the 10 just came back across the river. This is actually a pocket entry, and this was such a tight range that as soon if we get above 716, that's where the entry would be. We're already above the hump of the dragon, and that would be a continuation pattern. Then if it gets above 724, then off it goes. So we're really playing for a one-day short-term pop to get some kind of move like these large range days in that favorable direction. So that's the daily squeezes. These are the market mosaic stats. You see the gains the last 5 days have turned the polynomial regression line up. The 30 has started to improve its slope and come back to the 10-period moving average, and maybe a nice little bottom being put in here. It would be nice for the bulls if it could take off from here and not have to come all the way and test this. When it tested this, that's what that slope looked like. It sold off quite a bit, and now it's holding, it's starting to gain some potential on the long side. That's the optimist speaking. Just a quick shot at the daily stats. Z-scores of three regression lines, the 90, the 30, and the 10. The 90 has rolled over and holding. The 30 has started to hook back up. The 10 made a higher low and is now pushing the upper boundary. And so the price that came into the river held at the river's edge and now pressing the recent swing high level and perhaps ready to go. I still think the most likely case is this kind of a move where we get this chop because of the elections, but that's my bias and I acknowledge it. Frog stats. And that's everything I wanted to cover. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.